All right, let me ask you something. What do you think is the single biggest risk to the U.S. economy right now? In this explainer, we're about to dig into a threat that, honestly, almost nobody is talking about, but they should be. It's a story that's been brewing for over 30 years, and it's just now hitting a major boiling point. So yeah, let's get right into it.
So what's your first guess? What's the thing that really keeps the folks managing trillions of dollars awake at night? I'm willing to bet the answer is not what you think.
It's not the AI bubble. That gets all the headlines, right? And it's not geopolitical tensions with China or the latest political drama. Nope. Those are what I'd call the loud risks, the stuff that's right in your face. The real threat is, well, it's a lot quieter.
Believe it or not, the biggest risk is hiding in plain sight, inside what might be the most boring financial asset on planet Earth, Japanese government bonds. Yeah, I know. And because it sounds so dull, almost no one is paying attention, which is exactly why we need to.
Okay, so if you've been looking around lately and wondering why do things still feel so tight financially, or why the heck won't mortgage rates come down, or maybe you've seen the stock market just randomly have a panic attack, well, the answer doesn't start in Washington, D.C. It starts in Tokyo.
You see, for the last 30 years, Japan has basically been the financial duct tape holding the whole global system together. It's been quiet, but absolutely crucial. And now, that tape is starting to come unstuck. To really get why this is such a big deal, we gotta rewind a bit.
This whole story really kicks off back in 1992. Japan's massive asset bubble just bursts, and the economy grinds to a halt. We're talking about the lost decades, a huge period of just stagnation. The Bank of Japan, their central bank, threw everything at the problem. First, they cut interest rates to zero. That didn't work. So they went below zero. Crazy, right? And when even that wasn't enough, they brought out the big guns in 2016, something called yield curve control. All that really means is they were going to force long-term borrowing costs to stay near zero, come hell or high water.
So think about this for a second. If you're a giant Japanese pension fund or an insurance company, you can't just let your money sit there and earn nothing. You're left with two choices. One, accept basically 0% returns, which is a losing game, or two, go shopping overseas. And yeah, they chose option two, big time. It kicked off this massive, decades-long global shopping spree for assets.
And that right there is how Japan became, for all intents and purposes, the world's ATM. Just an almost endless fire hose of cheap money that flowed into pretty much every market you can think of.
The engine that powered this whole machine was something called the yen carry trade. Now, it sounds kind of fancy and complicated, but the concept behind it is actually super simple. You just borrow money where it's practically free, in this case, Japanese yen at near zero interest, and then you go invest it somewhere where you can get a much better return.
Let's break it down. Meet Bob. Here's exactly how this trade works. Step 1. Bob borrows a ton of Japanese yen for next to nothing. Step 2. He immediately swaps those yen for US dollars. Step 3. He takes those dollars and buys a super safe US Treasury bond that's paying, let's say, 4%. And the last step? He just sits back and pockets that 4% difference. It was basically a license to print money.
And Bob wasn't the only one doing this. We're talking about a trade that at its peak was worth trillions of dollars. Trillions. And really, only Japan could have pulled this off. Why? Because its economy was enormous, and its interest rates were stuck at zero for way longer than any other major country. It's like the whole global financial system was hooked up to a free, high-speed Wi-Fi signal coming straight out of Tokyo.
But, of course, there was a catch. There's always a catch, right? This entire global money-making machine was built on one single, absolutely critical assumption, that Japanese interest rates would stay at zero forever. And in 2024, that assumption shattered.
This was the inflection point, the moment everything changed. The Bank of Japan finally pulled the plug on yield curve control, and then, for the first time in 17 years, they raised interest rates. Just like that, the era of free money from Japan was officially over.
And the markets? They freaked out immediately. As soon as the news hit, you could just feel the panic. The foundation started to shake. You can see it right here. The S&P 500 dropped 6%, and Japan's own market, the Nikkei, took a massive 12% nosedive.
So here's the key takeaway. The simple math that made the yen carry trade a complete no-brainer for decades, it suddenly flipped. Borrowing in yen wasn't a free lunch anymore. And as a result, that massive 30-year river of cash flowing out of Japan, well, it started to reverse course. This is called repatriation, and it means trillions of dollars are starting to flow back home.
Okay, so a bunch of money is moving around to Japan. Why should you care? This is the part where a story about boring Japanese bonds suddenly becomes a story about your mortgage, your investments, your wallet. Let's connect the dots.
You know, the legendary investor Ray Dalio put it perfectly. He said, you have to watch the bond market. It's the foundation of everything. The interest rate on a U.S. Treasury bond, that's the risk-free rate that sets the baseline for the return on literally every other asset.
Now, a lot of people think the Fed controls interest rates, and that's only kind of true. The Fed sets these short-term rates, but the long-term rates, the ones that really drive the economy, like for mortgages and corporate debt, those are set by good old supply and demand. And for decades, Japan was a gigantic, price-insensitive source of demand for those bonds.
So what happens when one of your biggest customers just leaves the market? Let's start with stocks. The value of a stock is basically all its future earnings but pulled back into today's dollars. The rate you use to do that is tied to long-term bond yields. So when those yields go up because Japanese investors aren't buying anymore, the value of those future earnings goes down. This means stocks can fall even if the company's doing great business.
All right, next up, mortgages. Have you ever wondered why mortgage rates can stay high even when you hear the Fed is thinking about cutting its rate? This is a huge reason why. Your 30-year mortgage rate is anchored to the 10-year Treasury yield. And if one of the world's biggest buyers of those treasuries, Japan, is selling instead of buying, the price goes down and the yield has to stay higher to attract new buyers. And what's the result? Yep, mortgage rates stay stubbornly high no matter what the Fed does.
And finally, this hits businesses right where it hurts. Think of cheap credit as the lifeblood of corporate America. It fuels growth, expansion, everything. For decades, that fuel was basically unlimited. But now, without Japan's cheap capital in the system, borrowing gets more expensive. So what do companies do? They get more cautious, they spend less, they hire less, and that slowdown just ripples through the whole economy.
So you might be asking, if this is such a big deal, why isn't it on the front page of every newspaper? Well, honestly, because it's slow-moving and a little bit complicated. It's not a flashy headline about AI or some political scandal. It's one of those deep, foundational shifts that kind of just happens right out in the open, while everyone is looking somewhere else. There's an old saying on Wall Street that liquidity is like oxygen for the markets. And if you think about it that way, for 30 years, the yen carry trade was like a giant free oxygen tank hooked up to the global economy. Now, as that trade unwinds, that oxygen supply is getting thinner.
And all of this leaves us with one final massive question. For decades, the entire world benefited from Japan sending its savings overseas. But now, we're all about to find out what happens when the world's largest creditor nation finally decides it's time to come home.